Welcome back, it's me Adam, you're watching Unlimited Options Investing. I'm recording this as of Thursday close, and by and large, the markets have been actually pretty green on the week so far, which is kind of a little bit shady. So far in 2022, it's felt like by the time it's Thursday, Friday, markets have already been blood red, or if they have been green, they're usually immediately sold off right after, whereas investors were conditioned to buy the dip whenever things were going down. Investors in 2022 have been conditioned now to sell the rips. Whenever you see green, you just assume that it's going to go even lower than it previously was, the prior low. So in this video, I want to talk about whether the rally we've been seeing is for real. Is it just another bear market rally, a bull trap? We had Fed Chairman Jerome Powell speak back-to-back, testifying in front of Congress regarding monetary policy, inflation, and so we'll get into that, as well as I saw a Yahoo Finance article on bear market rallies I found really interesting. As always, as well, my favorite part, technical analysis. So taking a look at the SPY, today was up 1%. What we'll notice is that we had a gap up at the beginning of the day. Usually the beginning of the day is when retail traders are getting into the market, or rather, they're providing a lot of the volume at the beginning of the day, market orders from the day prior. And then what we saw was the market went down toward the close of yesterday, and then toward the end of the day, we had a big rally, and that usually is from Wall Street themselves, because what's really important when you're taking a look at candlesticks is what's the most important is where do things close, which ultimately gives a candlestick its shape, and that's what really plays on people's psychology. Similarly, we also look at the QQQ, gapping up, immediately going back to the close of yesterday, rallying again, very whipsaw back to the close of yesterday, and similar to the S&P 500, rallying into the end of the day. And over the past 5 days, the S&P 500 is up 2.03%, and there's been a really popular meme that's been circulating the web right now, that even though your account may be down 50, 60, 70, or 80%, whatever, the fact that we've been up 3% over the past 5 days, you're celebrating, even though in the grand scheme of things, you are a lot lower than you were 6 months ago or at the beginning of the year. So from Yahoo Finance, how bear market rallies trap dip buyers and frustrate investors. Bear market rallies are the stuff of legends. Born through a combination of conditioned dip buying and FOMO, or a fear of missing out from investors, the bear market rally's purpose is to maximize investor pain, and these events do it well. This immediately brings me back to the middle of March, after the Fed initially increased rates for the first time into the end of March, which we'll get to in this article momentarily. The market lures in new longs, only to eventually send stocks to new lows. At the beginning of bear market turns, these rallies are flashy and short-lived. As the market grinds lower, these rallies tend to grow bigger, more exciting, and quite deceptive. During the financial crisis, the market head-faked investors with 3 minor rallies from fall 07 through summer 08 of 8%, 12%, and 7% respectively, suckering in new longs near the 2007 record highs. And this will actually bring me to my Instagram page, which you can actually find below in my description. Don't forget to subscribe and like this video, by the way, on YouTube. So it's always fun to post optimistic content. It pays to be an optimist over the long term, but if we are in a bear market, and we wouldn't even know if we were in one until after the fact, which we eventually found out right now we are in one because the S&P 500 has fallen more than 20%. Ironically, I posted this on March 31st, the end of that first bear market rally we saw this year in 2022. So the S&P 500 bounced by 9% to 19% 6 times between September and December 2008. And again, what you see is that rip rally that eventually gets sold off, and very painful and very frustrating for investors, as we see in the Yahoo Finance article. So after all of these rip rallies, that's when markets really start to mess with investors. Declines of 45% and 51% from record highs were met with rallies of 18% and 24% in the fall of 2008, moves that came several months before the market's ultimate bottom in March of 2009. So very, very painful. It really messes with you. Those rip rallies that eventually get sold off, and for the market to not bottom for several months afterward. Suddenly, headlines were reading, stock market 20% off the lows, enticing traumatized investors, I like that word, traumatized, to possibly pull the trigger on what remained of their cash position, only to see new lows in the coming weeks and months. During the dot-com bubble burst, it took nearly 3 years for the bear market to finally shake out bank holders from the first tech mania. The S&P 500 dropped 49% from record highs before hitting its ultimate bottom in late 2002. Over the course of 2001 and 2002, the S&P 500 saw no fewer than 4 rallies of 19% or more. It wouldn't be until the spring of 2007 that the benchmark index would reach another record high, just in time, of course, for the aforementioned financial crisis. Not easy stuff, guys, to be an investor during the early 2000s. Bear markets test investors both on the way up and the way down. When the news cycle seems like it can't get any more horrifying, stocks seize an olive branch. Perhaps it is a reprieve from a hawkish central banker or a drop in sky-high oil prices. But no matter the catalyst, bear market rallies can send stocks off to the races, and weary investors don't want to miss out. Rinse, repeat. At its most recent lows, the S&P 500 was down 23%, and the rallies so far this year have been shallow and short-lived. Again, that March of 2022. The largest was roughly a 2-week move at the end of March that produced an 11% bounce for the index. March's move was particularly rough for traders, as this rally took out February highs, which weren't too far from the S&P 500's record close seen on January 3rd, 2022. Anyone who bought that breakout was traded to a 16% loss over the next 7 weeks. This bear, it seems, is still young. A less forceful 7% rally in late May, which started on my birthday, so I thought, all the stars were aligning. My birthday is going to be the low. Obviously, that wasn't the case. And early June was knocked down by inflation rearing its ugly head again, with a 4-decade high for the consumer price index, tipping the S&P 500 into official bear market territory. As we saw in my Instagram post, we don't know if we're in a bear market until, again, after we're officially in one. And I do believe if the CPI wasn't as bad a couple of weeks ago, that in fact my birthday could have been that low on May 20th, but lo and behold, CPI was red hot, and now we're barely off new lows again right now. But again, are we in a bear market rally? Is yet to be seen. From here, if history is any guide, this bear market will only get trickier and more frustrating as subsequent rallies likely grow bigger. If they don't scare you out, they wear you out, says alphatrends.net founder Brian Shannon. Something to keep in mind if we're sitting here at the end of June, July, or August, looking at the biggest rally of the year. So something to take into account, guys. In my opinion, I don't think we're going to be out of the woods just yet until a certain few amount of things happen, which I actually made a video about yesterday. 3 different things that need to happen in order for the Fed to turn from a hawk to a dove, and which potentially could see a rebound in both stocks and crypto. So looking at the SPY or the S&P 500 over the past 4 sessions, we have had green candles. It does look like things are reversing, at least for the very short term, but this mini uptrend that we're having is a part of a bigger downtrend that we've been experiencing since January 3rd when we hit those highs, and there's no reason to think that we've broken out of that until this downtrend has been broken out of that. Again, we can only assume this is a bear market rally, especially after that article, until either that Fed pivot or the price action tells us otherwise. So the first order of business would be breaking this downtrend since that bear market rally at the end of March, which would be this blue line, which would coincide pretty nicely with the 20 EMA on the daily. And then after that would be the 50 EMA, but really the high since the beginning of January. If we were to draw another uptrend, I don't want to keep it on the screen because it's going to get a little bit too messy, but it would coincide very well with the 200 moving day average, right? And we're very far away from that. I think once we do pass that 200 simple moving day average, things are a lot more convincing, which they were convincing back at the end of March, but we got faked out very, very hard. Again, bear market rallies can really deceive you. They're extremely frustrating and it's tough. So really there's no reason to believe it's anything but a bear market rally for now. And there's many different ways you could play it, whether we get to a certain key level and you decide to sell your positions and try to get in lower, but that's a very dangerous game because let's say it isn't a bear market rally and we do end up pivoting sometime in the summer after some kind of a rally, maybe these are the lows. So it's a very difficult game to play if you are a long-term investor because if you try to get too active, you're going to end up hurting yourself in the long term. Something I learned a very big lesson back in the last couple of years is that the more active you are with your investments, the more likely you are to sabotage your results in the long term. And taking a look at the NASDAQ, what we'll notice is that downtrend we had since that same time at the end of March, beginning of April, we actually look like we are breaking out of that downtrend. And if we zoom in from the daily time frame to the 4-hour time frame, that downtrend we had in the blue line coincides very perfectly with that 20 EMA. So we want to see that broken if we are to see a continuation of the bear market rally. I also want to take a look at the QQQ or the NASDAQ. That downtrend we had since the end of March, beginning of April, actually looks like it's being tested and broken through. And what this could be telling us is that technology could be leading the way in this bear market rally, especially as we've seen oil and gas stocks and the other sectors not performing as strong. And something I can actually show you that illustrates my point even more is looking at XLK to RSP. And what XLK is a technology ETF, and the RSP is the S&P 500 equally weighted. And what we notice is that we had, again, that little double bottom the end of May and the middle of June. And what we actually see is that we've gained strength above both the 20 and the 50 moving day average on the daily time frame. And even looking at the ratio of the QQQ and the SPY, we'll notice is that, again, the QQQ has been gaining strength above that 20 EMA, but still below that 50 EMA, both on the daily time frame. And really, all signs are pointing toward this being a bear market rally. There's no reason to not think it is until we're proven otherwise. And considering consumer sentiment, the Fed hasn't pivoted, and we've been selling off like no tomorrow. We were due for some kind of rally. Now, how high does it go? How fast does it happen? Is anyone's guess. Maybe we reach the high today, and then we're going to continue making more lows from this point forward. Or like the article said, as the bear market goes on, those rallies get even stronger and fiercer, and they trap more and more investors into buying the dip. Let me know in the comments below what are your thoughts. As always, like, subscribe. Check out my description below for links to my Instagram, my Twitter, and my TikTok, and I will see you guys in my next video.